Imagine this. You take $1,000 from your savings and invest it evenly across 10 of the world's most promising eco-friendly stocks. Then, you wait. You don't touch it. 5 years go by. What could that $1,000 become? $1,500? $2,000? Maybe more? Or reduced to just $500? From renewable energy titans to disruptive climate tech pioneers, we break down 10 eco stocks. We'll explore what each of these companies does, and most importantly, what your $100 investment in each could realistically grow into over the next 5 years. We begin with Consolidated Edison, ticker symbol ED. This is a traditional utility company that provides power to New York City. It's been around for nearly 200 years, and while it's not the flashiest company, it is one of the most reliable. ConEd is slowly transitioning into renewable energy, making investments in solar and battery storage. The advantage here is stability. It's the kind of company that pays consistent dividends and rarely makes dramatic moves up or down. But that's also its downside. Growth is minimal, and it's still dependent on fossil fuels. If you invest $100 today, expect a return somewhere between $121 and $134 in 5 years. It's your financial seatbelt, safe, steady, but not exciting. Next up is NextEra Energy, ticker NEE. Now this one is a different kind of utility. It's the largest producer of wind and solar energy in the United States and owns Florida Power and Light. It's growing its renewables business aggressively and has become a favorite among clean energy investors. The returns here are more attractive than traditional utilities, with strong management and a solid dividend. However, since it's still partly regulated and moves slower than tech stocks, it won't be delivering explosive growth. Realistically, your $100 investment could grow to around $135 to $147 over 5 years. Moving on to Orsted, ticker ORSTED.CO. Based in Denmark, Orsted is a pioneer in offshore wind and is widely respected for transforming itself from a fossil fuel-heavy company into a 100% green energy leader. Its projects span across Europe, Asia, and North America, and it's regarded as one of the cleanest energy companies in the world. The positives? Major ESG credentials, large-scale offshore wind farms, and strong government partnerships. The downside? It's expensive to build offshore infrastructure, and projects often get slowed down by regulations and politics. Still, if the green energy transition continues, your $100 could turn into $150 to $180 by 2029. Our next company is also Danish, Vestas Wind Systems, ticker VWS.CO. Unlike Orsted, Vestas doesn't build wind farms. It builds the turbines that power them. It's the world's largest wind turbine manufacturer and has supplied equipment to over 80 countries. This is a global industrial powerhouse. Vestas has decades of experience and a massive order backlog, which is a good sign. But it's not without its challenges. Tight profit margins and supply chain disruptions can be a drag. With that in mind, your $100 investment in Vestas could also reach around $150 to $180 in 5 years. Now we turn to Brookfield Renewable Partners, ticker BEP. Brookfield isn't focused on just one type of clean energy. It does it all. From wind and solar to hydroelectric and battery storage, Brookfield operates over 25,000 megawatts of renewable capacity worldwide. Backed by Brookfield Asset Management, one of the biggest infrastructure investment firms in the world, BEP offers investors a diversified way to access global clean energy projects. Its business is stable and built on long-term contracts, but growth is slower compared to tech, and it's sensitive to interest rates. Still, a $100 investment could yield $150 to $180 in 5 years. Let's pick up the pace with SolarEdge Technologies, ticker SEDG. SolarEdge is a tech-driven company that builds smart inverters, power optimizers, and electric vehicle chargers. It's one of the key players in making rooftop solar work efficiently. The company is global, profitable, and expanding into adjacent markets like EV charging and energy storage. However, it faces intense competition, especially from low-cost Chinese manufacturers, and its stock can be quite volatile. Even so, with its innovation and global reach, your $100 here could realistically grow to $200 or even $250 over the next 5 years. One of the biggest risk-reward stocks on this list. Plug Power, ticker PLUG. Plug Power is building out the entire hydrogen energy ecosystem, from fuel cells and electrolyzers to hydrogen fueling stations. It's partnered with massive clients like Amazon and Walmart. If green hydrogen becomes a core part of the energy future, Plug could explode in value. But the risks are big. The company is still unprofitable and burning through cash. If things don't pan out, you could see your $100 drop to $60. But if hydrogen takes off, you might be looking at a return of $300 or more. Up next is First Solar, ticker FSLR. This is the largest solar panel manufacturer in the United States and one of the few not reliant on Chinese supply chains. First Solar is rapidly expanding its manufacturing capacity, thanks in part to incentives from the U.S. Inflation Reduction Act. With strong profits and a growing backlog of orders, First Solar is well positioned to benefit from the clean energy boom. However, it still faces competition globally, and part of its success depends on political support. In 5 years, a $100 investment could be worth between $160 and $200. Now to one of the most exciting names in clean energy, Enphase Energy, ticker ENPH. Enphase makes microinverters, tiny devices that let solar panels convert energy more efficiently, and smart batteries for homes. They dominate the residential solar space in the US and are expanding fast in Europe and Australia. The company is profitable, fast-growing, and has one of the best margins in the industry. That said, its stock is sensitive to interest rates and fluctuations in the housing market. But if growth continues, $100 in Enphase could grow to $305 or even $480 in 5 years. And finally, we end with the giant, Tesla, ticker TSLA. Tesla is more than just an electric vehicle company. It's building energy storage systems, solar roofs, autonomous driving software, and AI infrastructure. It's innovating across sectors: cars, energy, robotics, and more. If Elon Musk's vision pans out, Tesla could redefine multiple industries. But it's also one of the most volatile stocks in the world, and its valuation often swings wildly. Still, even with moderate growth, your $100 here could become $250 to $370, or much more if robotaxis or full self-driving take off in a big way. So let's recap. You invest $100 in each of these 10 eco-friendly companies. That's a total of $1,000. In 5 years, a conservative estimate puts your portfolio at around $1,530. A more optimistic forecast, around $2,300. And if the stars align, if Tesla soars, if Plug Power breaks out, if Enphase keeps climbing, you could see that portfolio grow to over $3,000. But remember, this isn't financial advice. These are projections, not promises. Always do your own research and invest only what you can afford to hold long term.